So you want to start investing, and all of a sudden you make that first step and you start investing, and you invest $1,000 into Apple, 1,000 into Amazon, 1,000 into Google. Let's assume this is like partial shares. Now here's what happened, guys. All of a sudden the market makes a turn and now you're losing money. 10 days pass and you just lost around 30% of your entire portfolio. You're nervous, you're anxious, you don't know what's going on. Well, you have two options. You either sell or you hold. If you hold on to it, hoping they go back up, that's a great tactic, but in reality, sometimes big companies blow up and they don't come back from anything, and you might just lose all your money. Or if you sell it, you might cut your losses, but you still lost 30% of your entire portfolio because you had no idea this was going to happen so fast. Now, this is why in this video, I'm going to show you guys different types of ETFs, exactly 14 types of ETFs to actually give you some diversity in your portfolio. Now, what does this mean, Tommy? It means that instead of you losing all your money, you actually are diversified. So if one company goes down, it doesn't matter because you have another 499 other companies that are there, a part of your ETF. So you won't be able to lose all your money at once just because the market is crashing, okay? And on top of that, guys, you probably don't know this, but during 2008, when that whole crazy stuff was going on, well, guess what happened, guys? Some people actually made money by using an ETF that was shorting the market. You don't know about that? I do. Stick around in this video to find out exactly how people made so much money while shorting the S&P 500 with an ETF, okay? I'm going to teach you guys everything I know so far, plus 14 different types of ETFs you're going to start investing and diversifying your portfolio right now, today. On top of that, if you guys don't know me, my name is TommyBryson. I'm an accountant. I post videos on YouTube every single day, daily content on a daily basis. Subscribe to the channel, notification bell so you get notified every time I post a new video. Do me a favor, hit the like button, really appreciate it. And here's a question. Have you ever watched the movie Big Short? It's the most important question in this whole video here, okay? Comment down below, let me know. And if you haven't watched that movie, definitely watch it. Again, The Big Short. I'm not sponsored, but I like the movie and you should watch it too. It kind of relates a lot to this video. So the first thing I want to clarify in this video is, well, Tommy, why are ETFs so important, right? So important, you know? And the answer is this, you know, ETF stands for exchange traded funds, and the main thing is this, right? These are, imagine like a basket full of eggs. Well, instead of having one egg, you have multiple eggs. If you crack one, doesn't matter, you still have a bunch of eggs left, okay? And this basket is full of stocks, commodities, bonds, all types of securities, okay? So here's my thing, guys. Say, for example, you buy into a fund and an ETF, for example, and this ETF has around 500 different companies. Well, one of those companies go bankrupt. Well, it doesn't matter. You still have another 499 companies in that entire fund, so your portfolio is less likely to actually lose a massive amount of value, unlike if you just invested into one company and it went bankrupt. Well, you just lost that one egg, and now you're kind of screwed because you just lost all your money. So a hot tip is this, guys. In this video, I'm going to show you all the different types of ETFs, right? But this does not mean just to invest in ETFs. It's just me telling you, like, hey, this gives you diversity, diversify your portfolio, and it helps you out in case the market does go down. But you can also still invest into individual stocks once you do the research, okay? Just to clarify that, because I'm not saying like, hey, only do ETFs. No, I'm trying to show you guys how to create a balanced portfolio so you're always secured even when the market goes up or down. Up or down. So when it goes up, you make money. When it goes down, you make money no matter what. So comment down below if this makes sense so far, and if you like the sound of making money either if the market goes up or down, okay? Because I definitely like the sound of making money every time the market goes up or down. So now let's get right into the video and actually talk about the 14 different types of ETFs and how they actually work and all that fancy stuff that you probably don't know, because I'll be honest, before watching this video or before making this video, I wasn't aware of around like 75% of these, okay? Because it gets really complicated really quickly, but don't worry, I'll break it down very simply. Now, number one is this, guys. You also have the United States Market Index ETF. Now, these ETFs are responsible for tracking maybe like the S&P 500, right? For example, I invest in Vanguard in a fund that I actually have with the ticker symbol name VOO. And this ticker symbol is responsible for tracking the S&P 500. Now, they don't try to outperform it. They don't do that. They don't actively trade it. They don't do that. What they do is this. They just try to emulate it. That's all they do. Just emulate it. So what I like to do is this, guys. Sometimes I want to have a fund in my portfolio that's just trying to track the market, not outperform the market, because we've seen it several times. That doesn't really work. So why would I try to outperform the market when it doesn't work, okay? So that's number one. let's go to number 2. Now, number 2 is actually ETFs made out of bonds. Now, here's the thing, guys, right? When you have bonds, you have to wait until they mature, usually. But when you have an ETF made out of bonds, you don't have to wait. So in this case, you have more liquidity. So on top of that, here's my thing, guys. It gives you stability and also liquidity. And here are 2 different types of ETFs made out of bonds that I actually invest in myself. So the first one is for government bonds and then also corporate bonds. So for the first one, the ticker symbol is actually SHY. And so far this year, I've had a return of around 1.7% so far, which is fair, not crazy or anything like that. But again, it's stable. It's kind of like rock solid. It doesn't go like this. It goes like this, you know, because it's like government, okay? So it's like more stable. On top of that, we also have corporate bonds, and the ticker symbol for this one is actually LQD. And so far this year, it's had a return of around 13.5%, which is a lot of money if you ask me. On top of that, guys, here's a hot tip, okay? I want you guys not to just think about, okay, I want corporate because I get a lot of money. Well, the answer is this. The market is really doing very well now, right? But eventually, this will fall, right? And when it falls, these things are gonna fall also. So you want to make sure to also have government bonds. So when it does fall, you're more secured. And you also know one thing, right? I'm diversified. If it falls, if it goes up, I'm still gonna be maintaining some type of stability because I have corporate and I also have government bonds. And that's what I like to hear, okay? Now, the third type of ETFs are actually ETFs made out of commodities. So for example, gold, oil, energy, water, all that fancy stuff that we like to hear. But in reality, guys, I'm not a big fan of that stuff. Why? Because, you know, commodities, raw materials, they don't really do much and they don't really fluctuate that much, and they can fluctuate a lot depending on the market. So when it comes to me, I like having things that return money back to me and not things just sit there and look pretty, okay? I'm not a big fan of like sitting there and looking pretty. I want some money, I want some returns, and usually these ETFs don't really return that much. On top of that, here's an example. You have a ticker symbol. It's called PDBC. I'm going to put it right here. But here's my thing, guys, right? This is not financial advice. I want you guys, though, to look up these entire companies I'm showing you guys here. Look it up, see what's up, and then like, do some research on it. But don't invest into them. Don't just be like, okay, he said this, so I'm going to do this. No. Do some research and then come back to me, comment down below and be like, hey, Tommy, I found this out about the company. And let's try to learn together, but don't just be brash about it, you know, just to be like, okay, I'm going to invest $10,000, $1,000. No, take your time with it, learn, research, and then execute, okay? Now, number 4, guys, is actually international ETFs. I know, you know, United States is so great, it's so amazing, but we also want to diversify just in case anything does happen here. We're also diversified all across the planet, okay? Because there are other places aside from the US. So here's my thing. International ETFs gives you more diversity, but it's also more risky because right now, America is a superpower, so we have more stability, but eventually, you never know what's going to happen. So just in case something happens, you also are diversified outside of America. Now, it's not just stocks or commodities. You can also do bonds internationally with some ETFs. So here's one, guys. You also have a bonds ETF for international companies. Actually, ticker symbol is actually BNDX. And for stocks, you also have a ticker symbol of VXUS. Okay, so I'm going to put it right here also. Now, by all means, I do recommend you search the examples, the ones that I just said right now. Search them up, look them up, and be like, okay, this is great. This is what it does. Here's my dividends. Here's what this does. Here's what that does. You know, just search it up, do some research, and be like, okay, this is great. This is not great. Okay, comment down below when you find it, though. Now, I know we're talking about international stuff, but we can also invest into foreign currencies with an ETF. So, for example, we have ETFs made out of the Australian dollar, and we also have ETFs made out of multiple currencies in just one pile of things. Okay, so that's pretty cool if you ask me. But on top of that, it's kind of like more risque. So you can try it if you want to. But for me, I'm not a big fan of like the currency type because again, I try to stick to what I really understand and just focus in on that. But if you want to try this one out, like by all means try it out and let me know how it goes for you. But for me, I'm not a big fan of currency trading games because again, it can get very complicated very quickly depending on how the currency and how the country is actually doing. And we've all seen countries go from pretty great to having like people carrying buckets of cash just to buy a piece of bread because of inflation. Okay, just to clarify. Oh, and you're probably wondering, oh shoot, I almost fell down. Okay. Oh, and you're probably wondering, well, Tommy, what's an example? And the answer is this. You can actually look up this ticker symbol right here for an ETF. It's actually called FXA. and it actually tracks the entire Australian dollar through an ETF, and it shows you the return over time, all that fancy stuff. But again, I'm not a big fan of this, but if you are, let me know. Now, number 6 is by far one of my favorites, because again, I had no idea about this one. It's actually called inverse ETFs. Comment down below if you know what this means before I even tell you, okay? But the first thing is this, guys, right? Originally, I thought this, okay? Because everyone on YouTube talks about one thing. Oh, track the market. Oh, do S&P 500. Just do that, okay? Just leave the money there. It'll track it forever. You'll be good to go. You'll make a lot of money. I've always thought about them like, okay, that's great. That sounds cool. But with inverse ETFs, you can actually short the market. So, for example, during 2008, when that whole debacle happened and people were losing money left and right, there's actually something called, or an ETF actually called SH. Look it up on Yahoo Finance, okay? SH during that time was trading around $210 because it was being shorted by the market. So, it was shorting the market. So, for example, every time the S&P 500 lost money, this entire ETF actually went up in price because it was shorting it. Now, here's my thing, guys. Today, this ETF is worth around $27.05. Now, I'm telling you this right now. This is not financial advice, but here's my theory. If the market goes down and you're buying it at a very low price, right? And you invest around $10,000, that's around a $70,000 profit when the market does go down, if it does trade for like around $210. So again, it might be a good time to get into this, but again, I just want more diversity into your portfolio. So for example, if all you do is track the market, you also want something that leverages the market. So then that way, if you lose money here, you gain money here also. It's like a seesaw. You see and you saw, like this, okay? If it makes sense, well, let me know. But if it doesn't, don't let me know. Okay? But again, guys, it's a seesaw. It's pretty cool. So if you lose money here, you actually gain money here with an inverse ETF. I had no idea about this, but now I do, and I'm going to add it to my portfolio for sure. Now, number 7 is actually leverage ETFs. We've been talking about leverage a few times in this video, but leverage ETFs are kind of like very complicated because it's kind of like trading. Now, here's the thing, guys. They actually actively, daily, rebalance the entire structure of the ETF just so they can make extra money and leverage the entire thing. So for example, they take certain things out, they put in certain things just to make a little leverage here and there to make you more money on a daily basis. But again, for me, this is not the way to go because again, I'm all about the long-term game and I'm not trying to make like a daily profit or a daily loss because again, it's very hard to track the entire market and to beat the market on a daily basis especially. So again, leverage for me, ETFs are not that popular, at least for me, and I don't really like it, but it might be for you if you want to be like actively trading ETFs consistently in front of a screen every single day. So it might be an option, that's what I'm putting in here. Now, number 8 are actually actively managed ETFs. Now, I'm not a big fan of this. Why? Because they're trying to like, kind of like beat the market in a sense, and you can't really do that. But here's the main thing, guys, right? The best way to know if a fund is actually being actively traded is by 1, calling in, or 2, you can just like look at it. For example, if there's a fund or an ETF, right, trying to track the entire like S&P 500, and you see there's a difference in returns by more than 2%, it's actually called a trade error. That shows you that it's actually being actively traded because again, when you're actually tracking something stock by stock or like commodity by commodity, there's not going to be a larger margin of error of like maybe like 1%. Anything above like 2% is like crazy and is being actively traded. Now, I stay away from this stuff because one thing is this, they usually have a very high expense ratio because they're actively trading it, and they usually also develop high premiums. So again, for me, not my type of stuff, especially when you're trying to like do something for the long term, and I don't really want to spend a lot of money and fees for the long term. Not my type of style, okay? But if it is yours, stop it. It's not, I don't recommend it at all, okay? Oh, and neither does Tony Robbins, because he mentions it in his book also, saying like, hey, make sure those funds are not being actively traded because again, they can get very expensive very fast. Now, number 9, guys, I want to make sure you walk out of this video knowing more than what you came in knowing, okay? So here it is, guys. There's actually something called an ETF. You already know what that is, right? Exchange Traded Fund. But there's actually something called ETN, an Exchange Traded Note. So for example, the bank gives out notes. They form ETFs out of this, ETNs out of this entire thing. It's not really backed by anything. And here's my thing. You don't really get taxed short term on the dividends because the dividends actually reinvested into the entire fund. Thus, you never get taxed on it until you actually collect the entire thing, But my main thing is this, right? This is a little risky. A little bit. Now, here's why. Because you would think like, hey, Tommy, these are notes from the banks are secured. What are you worrying about, okay? Well, I'm worried about because, in 2008, banks went bankrupt. So we do know that banks are not superheroes. They can actually go bankrupt. And if that does happen, you might just be out of luck and you might just lose all your money. So again, just to clarify, ETNs are notes made up by the bank, and they form like an ETN around it, or an ETF, whatever you want to call it. And at the end of the term, they mature and you get your money back. Okay. Now, they're not that popular, so you can't really trade it as often because there's not that much demand for them out there in the market. Now, this might be an opportunity, or it might just be a sign of like stay away, but it's up to you to actually figure that out. For me, I stay away. I'm not really a big fan, but for you, it might be an opportunity. You never know. Don't take my word for it. Now, number 10 are actually sectors and industry ETFs. Now, tell me, what is this? Well, the answer is this, guys. Have you ever wanted to invest into an industry like, tech, pharmaceuticals, all that fancy stuff, especially that illegal stuff that now is legal? People do it all the time, but it was never legal. I can't say it, I can't, but that type of stuff, well, you can actually invest in the sector or in the industry through an ETF, so in that way, you're more diversified instead of just taking a risk on one company. Like, for example, I want to do tech. Let's go into Google, Facebook, Apple, all this fancy stuff. If those companies go down, you're kind of screwed. But if you get an ETF, if one goes down, doesn't matter. You still have another 499 depending on the fund size of your ETF, okay? Just to clarify that. Now, so far, we've spoken about around 10 of these ETFs, and the last 4 are very simple, but also very complicated, dependent on what you want to get into. So, number 11, you can also invest into derivatives, ETFs, that's like options, puts, and all that fancy stuff that's very complicated. You can actually do that if you want to, and also contracts can get very complicated if you don't know what you're doing. Number 12, you can also invest into market style ETFs. For example, if you want to copy or mirror Warren Buffett style, like a certain person out there style, well, you can actually do this through an ETF. Great. Now, on top of that, you can also invest into dividend ETFs. It's all about the dividends. You want to make a lot of dividends. Well, you can invest into one of these ETFs that get you a lot of dividends every single quarter or every single month, depending if you're doing bonds or if you're doing stocks, okay? It just depends. So, guys, so far, that's 13. The last one is actually innovative ETFs. Now, what this sounds to me, well, what it might sound to you is like, okay, Tommy, this is great. Innovative, okay? It's just so amazing. What it sounds to me is like this, okay? It sounds risky ETFs, okay? Innovative stuff is usually brand new, no history, usually pretty risky, and I don't really want to get into it. But if you want to, you can actually get some ETFs that are based around innovative stuff, like new markets that are ranging, like popular now, whatever it is, okay? So you can actually get into all that type of stuff. But so far, guys, I've given you around 14 types of ETFs. Comment down below and let me know which one is your favorite and which ones did you not know anything about. Now, my favorite is actually the inverse ETFs, because I had no idea you can actually make money when the market is going down by shorting it through an ETF. I always knew about like shorting stuff, but I never really know how to do it. But now, it's a game changer. Comment down below, let me know yours. And before I go, I want to leave you guys with my final thoughts. And here they are. My goal for this video was to give you guys a lot of different options, so in that way you can actually make your portfolio a little balanced, okay? Because again, it's all about balance and creating something that goes up and down, and also up when things are going down, okay? That's what you want. On top of that, guys, here's my thing. If you found any of this stuff interesting and you want to get into it, I highly recommend you take my examples, you study them, you research them, and you keep doing more and more research, or you even talk to a financial advisor before you go and execute on these things, okay? Because again, it can get very complicated very quickly, and you want to balance it out, and the only way to do that is by learning and being educated. How do you do that? By reading and also practicing and all that fancy stuff. But again, be careful trying to do this stuff without knowing how to do it, okay? Don't just like be like on a whim. I'm gonna buy this, no, don't do that. You're gonna lose your money, okay? I just wanna make sure you're safe, so stay safe. On top of that, guys, as always, thank you for watching the video. If you like the video so far, or at the end, because I'm ending the video right now, like the video, really appreciate it. On top of that, subscribe to the channel, notification bell so you get notified every time I post a new video. On top of it, if you want to talk to me one-on-one, uno, just DM me on Instagram at TommyBryson. And if you want to watch more videos, click this one right here. I have a whole playlist on stocks, bonds, all that fancy stuff. And I also have my face right here. If you click this face, I promise you, you'll be able to subscribe to the channel without having to click subscribe on the bottom. So click my face right here, and you'll subscribe right now. I'll see you guys tomorrow on the next video. Thanks for watching, and peace.